Hi everyone, welcome to ESOP Radio. Today, we're doing a deep dive on the 2026 valuation trends of AEC companies. And by AEC, I mean architecture, engineering, and construction. According to a recent survey by Zweig, ESOPs are outshining their non-ESOP counterparts on valuation, and by pretty far on valuation. ESOP valuations are often higher than other valuations, internal, for instance, which a lot of AEC companies rely on, because they are fair market value based. And an independent appraiser takes that into account. So you have to include key drivers such as backlog, profit per employee, market EBITDA multiples, strength of the balance sheet, and company risk. And this might be one of the key reasons why there's a big delta here. We noticed 5 key metrics that are driving ESOP and non-ESOP valuations. I'm Trevor Gilmore, CEO of Menke.
And I'm Ben Spadt, investment banking with Menke.
Let's dive in, Ben. What are those 5 key metrics that are enabling ESOPs to lead the pack in valuation?
Sure. Number one is, the company valuation divided by net service revenue. So value over service revenue. And we see that there's, about a 25% premium for ESOP companies. And that means that these values tend to be higher for the same level of revenue company. And if you think a company does $10 million in revenue that is an ESOP, and a company that does $10 million in revenue that is not an ESOP, that ESOP company is going to be valued 25% higher.
That's pretty meaningful upgrade there, and valuation premium, 25%.
Absolutely. And I think you alluded to it a little bit in the intro that, these ESOP companies have to have an independent valuation. It's not just a buy-sell agreement. It's not a business broker that is using some rule of thumb method that is determining this value. And that there are metrics and elements that go into this that take in not only the health of the company as far as the financial statements go, but what is the industry at large doing? What is the economy, both local and nationally, doing? And I think a lot of that plays into this increase that we're seeing. And I think, another element you hit on was the backlog component. And do you want to talk more about that, Trevor?
Yeah, absolutely. So we tell this to our clients all the time who are in the AEC category. Big part of your value for ESOP purposes, or even in the open market, right? ESOP as a fair market value valuation is your backlog. And you need to know it, have great insight into what it is, and really maintain that backlog as well. One of the key metrics that we noticed in this valuation survey is that ESOP valuation per backlog, and this is a multiple here, is 1.22x. So 1.22 times. So that means, hey, if your backlog is 10 million, then the value for ESOP purposes using this metric is going to be 10 million times 1.22. That's meaningful. Compare that to the non-ESOP counterparts. That's only 0.63 multiple. So what that tells us is ESOP companies have a valuation of roughly X on that metric compared to the non-ESOP companies. That's huge. And, you think, okay, if I'm an appraiser going in, valuing this company for fair market value purposes, the backlog is the story of the future. And that's what I'm buying. I don't want to buy the past, I want to buy the future, right? So this shows that these ESOP valuations are getting credit for that. Whereas these other valuations in the survey, non-ESOP purposes, it could be, as you mentioned earlier, internal buy sell, and so on, are not taking that into account. So if you're relying on that for an exit, you could be leaving money on the table.
Absolutely. And I think not just leaving money on the table, but it alludes to the fact that these ESOP companies do have a stronger forward visibility. They are understanding the projects that they have in front of them a lot better. What their cash conversion cycle is might be understood a little better or might be a little tighter than those that don't. And I don't think it's a factor. An ESOP company is not going to create this strong forward visibility, but it's one piece of the puzzle that we always allude to. We talk about culture, that an ESOP company is not going to create this culture, but in tandem, that strong forward visibility and being an ESOP company is huge. And when those backlogs are well understood and well accounted for, you're going to understand how you can make a reliable income stream. And that reliable income stream is the thing that is taken against a multiple to determine company value. So, it's pretty simplistic, but that backlog, and we harp on it all the time. And then, understanding that and having those cash flows come to the bottom line, we then hit, Uncle Sam tax. And a lot of these non-ESOP companies have to pay the piper in terms of tax. But if we have 100% S-Corp owned or ESOP owned S-Corp, then essentially we're not paying any tax. There's this huge tax shield by implementing an ESOP and having essentially, like I said, a tax-free entity, which means higher cash flow, which means a higher valuation on not only the revenue, but the backlog, like we talked about.
Absolutely. Yeah. And the third point there, key metric here is the tax savings.
Mm-hmm.
So S corporation owned completely by its ESOP does not need to make tax distributions. It operates tax-free. So cash flow savings happen, there's on the cash flow statement, balance sheet, et cetera. You don't need to distribute cash to pay tax. Huge. Multiply that, over how many years, and so on. And it becomes a, good driver there for value because your cash is going to increase, all things equal.
Yeah.
So that is the third metric there. So never underestimate the power of that S-Corp ESOP tax shield. And I will note here for anyone well-versed in valuations, of course, the fair market value always does impute tax, right? You always say, hey, the hypothetical buyer is a C-Corp. So you're not just going to put 0 in that tax rate. You're going to put that C-Corp rate. But the company is still going to have more cash, which means the valuation, which takes into account excess assets, excess CATs, minus long-term debt, that cash part is going to be higher. So we're seeing that in this data. The fourth data point, which I think this rings true for everyone talking about value, is EBITDA. What is your EBITDA multiple? And Ben, define what EBITDA is as a favorite corporate buzzword.
Yeah.
EBITDA.
And, it comes back to accounting 101. Both you and I are CPAs, and this is sort of etched into our brains now, but that's earnings. That's the E, before interest, taxes, depreciation, and amortization. And so all of these things that either are not cash, like depreciation and amortization, no cash moves hands in terms of that. And then interest and taxes. Different strategies will be put in place by different owners. And so we need to understand what are the cash flows before those choices. Am I going to take on debt where I have to pay interest? Me as an owner will have a different opinion than you, Trevor, as an owner of this business. So let's eliminate that. And then taxes, if it's an S-Corp, you may be taxed at a different rate. I may be taxed at a different rate. We could live in different states that have different tax rates. So just for ease of use, it's earnings before income or before interest, taxes, depreciation, and amortization. And go ahead. That helps drive value with that cap rate. And you want to talk more about that?
Yeah. So EBITDA multiple, and you talk about EBITDA multiples, and you never really talk about the cap rate. You always say, hey, it's 5 times, it's 7, it's 10, and so on. But the EBITDA multiple is really driven by the cap rate, and that's where you get the numbers. So the cap rate is a percentage, and it is calculated by the independent appraiser, and they have to take into account current economic metrics, such as the risk-free rate of return, industry-specific risk in your industry. Whole databases out there that you can pull data to get that number. Company-specific risk is also included. Smaller companies have higher risk, larger ones don't. And that's in a nutshell. There's more that goes into it, but at a very high level, that's what makes up your cap rate. So let's just say your cap rate's 20%. That means your EBITDA multiple is 5. So 1 divided by 20% equals 5. That's where the EBITDA multiple comes from. We're seeing here is ESOP companies in this survey have higher EBITDA multiples compared to their non-ESOP peers.
And again, Trevor, I think that alludes to both a buy-sell agreement. We're not taking into consideration any cap rate, anything like that. So your multiple is going to be somewhere across the board, but we don't know where. And then if you deal with like a traditional business broker, they're going to say, well, I need a cap rate of 25, 30% in order to make this investment make sense. And they're just going to apply a blanket cap rate. They're not going to look at, like you alluded to, that industry-specific risk, company-specific risk. What is a buyer that wants a risk-free investment? What do I need as a return? And so we got to add that into it. But I think you're absolutely right. We're taking a more critical look at what kind of a return do I need as just an investor in a company, this company.
Exactly. And that's, at the end of the day, that's what that rate is. Hey, what would a hypothetical investor require as a rate of return to invest in this business? And it's more often than not, it's much higher than prime. It's going to be prime right now, 6.75% as of March 26, 2026. These cap rates are going to be much higher, right, for small businesses. So it's going to be something higher. So it takes into account everything that we described, the company's risk, the future, current economic trends. You can invest the money and actually get a risk-free return and so on.
Right.
And lastly, the fifth metric that really drives these higher ESOP valuations, and again, this comes into play in the cap rate and so on, is the lower risk profile that ESOP companies have compared to their non-ESOP peers.
Yeah, you're absolutely right. And it's all boiled down to this. We have an internal market for these shares, so I don't have to find somebody to buy them. The buyer is not hypothetical, and therefore we don't have to depend on what an outside investor would demand for a return. We have one that's established in this market. And then that broad employee ownership means the employees are going to stay with the company because they can see, I've got skin in the game. We hammer on that a lot, and it keeps growing. My account balance keeps growing. And predictability in your staff, predictability in your backlog, predictability in your earnings, all of those things become evident and lead to a lower risk profile.
So predictability is the key here, with the lower risk profile, and that's what we're all looking for, right? Is predictability. Great point there. So in summary, the survey proves out the notion that ESOP valuations outshine their non-ESOP peers, and in some metrics by quite far. And just a data point here, I was talking with an engineering firm recently whose internal valuation is 4.5 times EBITDA, yet the market multiple for them is closer to 7x, so 7 times. So we're talking about a 2.5 multiple difference. Huge difference there. Those differences can make the ESOP very interesting. And that engineering owner said, hey, well, okay, but how can this whole thing work? Because right now we're buying people out using cash flows of 4.5. You say we can go ESOP and maybe the value is closer to 7 for us. How can it cash flow? And the answer is, well, you're not going to be paying tax. You're not distributing 40% of the earnings or 50% if you're in a high tax state to cover those annual tax payments that all those S-Corp K1 shareholders need to make each year. So that's one reason, or one way that just at a high level how this whole thing works on the cash flow perspective here. Ben, before we wrap this up, any parting comments?
No, I think you're right. And I think, we get down to it where when you're on the golf course, there's one price that you're going to talk about. Oh, my company's worth, $5 million, $10 million, whatever, or 5X this, 10X this. And you had a great LinkedIn post where you talk about 10X what? And we talk about it on another ESOP Radio episode. And we, as, your advisors in this journey, can help guide you to understanding what we're talking about when we talk about multiples, when we talk about discount rates, things like that. And I think that this is very telling of how strong ESOP companies can be and how much more predictable they are, how much more reasonable they are in terms of an investment.
Thanks, Ben. Thanks, everyone, for joining us today. If you're curious to learn more, reach out. We love talking valuation. Both Ben and I have valuation credentials, talk about this stuff all day long with our clients and our prospects. Our ESOP Fit tells you which direction is right for you. Please shoot us a note or connect with us on LinkedIn, Spotify, Apple, YouTube, or Menke.com. Have an awesome day, everyone. Take care.
Thanks and goodbye.